Welcome to the third video in the Evaluating Farm Financial Performance section of our Farm Management Educational Series. I'm Rodney Jones, and in this segment I want to walk you through an evaluation of an equipment purchase for the example case farm from the standpoint of the 5 categories of farm financial position and performance that we've been talking about in previous videos in this section of the course. Recall that the case farm represents a modest-scale combination crop and livestock farm that currently owns relatively little farm equipment since they no-till their cropland and they hire the spraying and harvesting done on their 450 cropland acres. Assume for a moment that, like many farmers, they would really like to have a little more equipment so they don't have to rent, lease, and custom hire so many operations done. Recall that they do have a modest-sized tractor and they've been renting a no-till drill for their planting operations. They really like the looks of a nice no-till drill that they've been eyeing, and they reason that it might be a good purchase since they know that they can get low-interest financing from the Farm Service Agency, and they would save the $2,250 per year that they're currently spending to rent a drill. They do realize that if they owned the drill, they would be responsible for all the repair and maintenance issues, which they project would cost them about $900 a year. They calculated the payments on the drill they are considering, and over a 7-year loan, the principal and interest payments would be about a little over $9,000 a year, $9,024 a year. Let's look at the projected impact on financial position and performance measures if they were to purchase this drill. In order to calculate the comparison measures, we created financial statement projections representing what would happen in a typical year following the drill purchase based on recent years' production performance. First, let's look at the impact on liquidity. For example, we're going to use the projected impact on the current ratio. Recall that without the drill purchase, the current ratio was at about 1.38. If they were to follow through with this particular capital purchase, the current ratio is projected to decline to about 1.14 after the purchase. This is, of course, the result of the principal and interest payment that would need to be made in the next year. That projected 1.14 number appears dangerously close to creating a high-stress liquidity situation for this farm. Now let's look at the projected impact on overall solvency by examining the projected impact on the debt-to-asset ratio. Because the drill purchase would be financed with debt, the solvency position would be projected to deteriorate from about 0.33 to about 0.38 as measured by the debt-to-asset ratio. This would not be an extreme change in the solvency position, but certainly would be a move in the direction of creating a more financially vulnerable position. From a profitability perspective, the return on assets would be expected to decline from an already cautious number of about 2.6% down to about 1.7%. Looking at a common financial efficiency measure, the asset turnover ratio, since the drill purchase is not a huge percentage of the overall asset base of the farm, the impact on the asset turnover ratio is not really very large. However, the asset turnover ratio is projected to deteriorate slightly if this particular capital investment purchase is made. The most serious problem with the proposed drill purchase shows up in the term debt coverage ratio, which is of course a measure of debt repayment capacity. The farm only had about a 13% cushion regarding their ability to make principal and interest payments on existing term debt to begin with. The drill purchase would add enough anticipated term debt payments to that burden that the term debt coverage ratio would be projected to fall to about 0.86, indicating that the farm would fall short of having enough cash available to make all of its term debt payment obligations. Overall, The wisdom of this particular capital purchase decision appears to be very much in question. From a feasibility perspective, both the current ratio and the term debt coverage ratio would be projected to significantly worsen. It is clear from this analysis that it would be very difficult for this farm to make the payments on this proposed purchase. Another feasibility indicator that will be discussed in the Financing a Farm section of this educational series is called the payback period calculation. That basically provides an indication of how long it would take for the investment to pay for itself. We'll save the details of that calculation for that later session, but in short, the payback period for the drill purchase decision in this case is about 42 years. That's far longer than the drill would be expected to last, and much longer than the terms of any loan that could be obtained to potentially purchase the drill. From a profitability perspective, the proposed drill purchase presents some challenges as well. As previously demonstrated, the return on assets would be projected to deteriorate significantly. While not shown here, we also calculated the return on equity. If this particular capital investment were made, return on equity would be projected to turn negative, meaning that the farm equity would be expected to drop over time. In more detail will be provided in the Financing a Farm section of this educational series, but briefly, a couple of profitability measures that are designed to evaluate capital investments on their own merit do not appear very positive for the drill purchase decision. The net present value, or NPV, of the drill purchase is projected to be more than $26,000 on to the negative side. This essentially means that purchasing the drill would be expected to reduce farm wealth by over $26,000 over its expected life. Similarly, the internal rate of return, or IRR, evaluation of the drill purchase turns out to be about negative 10%, meaning that the drill purchase by itself is projected to generate a significantly negative return on investment. While this example was of course designed specifically to demonstrate some extremes, the exercise does show that it is always a good thing to do some analysis and give careful consideration to significant financial moves for a business. This example revealed some significant liquidity, debt payment, and profitability concerns associated with the proposed drill purchase, so the decision appears to be unwise from both a feasibility and a profitability perspective. Analysis of this type always leads to questions regarding what could be done differently to make a more financially sound decision. Of course, there are an unlimited number of possibilities to answer that question. Certainly, continuing to rent a drill is one option that remains an alternative in this instance. If the farmer is still convinced that they'd like to own their own drill or piece of equipment, they might consider evaluating a much less expensive option, more usage, smaller, etc. They might also consider whether or not there would be any opportunity in their geographic proximity to use this as an opportunity to diversify and take on some custom planting work, for example, to better utilize the capacity of any equipment purchases that they might be considering. In this example, we provided an illustration of how to evaluate a proposed significant change, in this case, a significant capital purchase, by projecting what would happen to financial position and financial performance in each of the 5 categories previously discussed. Monitoring and projecting position and performance in the areas of liquidity, solvency, profitability, financial efficiency, and debt repayment ability will help the farm to run much more smoothly and can sometimes provide a needed caution signal that prevents the farm from moving forward with big changes that could prove unwise. In the next video in this section, we'll take a look at some things the farm can do when faced with a financially stressful situation.